Have you ever heard the expression, he knows the price of everything but the value of nothing? Often said about someone who's quick to point out that an item is cheap, but without realising that price is not necessarily an indication of value or its worth. A cheap table, for example, isn't cheap if it breaks after one use, you know, that type of thing. And so it is with choosing shares for your portfolio. In this video, I'm going to go through how I choose my shares for my portfolio and the reasons why. For this, I'm going to use my favourite tool, which is Stockopedia, which you can use also for an extended trial period if you use the link in the description below. If you're using it already, that's absolutely fantastic. Give me your opinions of it in the comments as well. So without further ado, let's get straight into it. I'm Anthony, and as always, we're talking money. On the UK stock market today, there are about 2,000 stocks trading on the various exchanges, including the largest FTSE 100 companies to the newly listed startups on the smallest AIM market. In America, there are thousands more, and worldwide, hundreds of thousands. So how on earth are you meant to sift through all these objectively to come up with a list of rationally chosen stocks? Well, whether you just trade in UK shares, which is what I do, or want also US, Asian or European shares, using Stockopedia is probably the best sifting tool that I've come across, because you can enter the criteria that you want for your stocks and have the software filter out everything out that doesn't meet your criteria. So I'll show you how I reduced 2,000 UK shares down to just a handful from which I buy my shares. I'll also give you why I choose the criteria that I do. This may get a little technical, but here goes. So in order to put some kind of valuation on a price, most people who invest in shares have heard of the PE ratio. As a figure to get a sort of valuation on a share, this at least attempts to qualify a price by putting an earnings factor in. But personally, I think it's a little bit too simplistic. Although anecdotally, low PE shares tend to outperform high PE shares. The PE ratio attempts to give you value, but it really doesn't do a great job. If it did, Tesla, for example, wouldn't have a PE ratio of 831, or Imperial Tobacco wouldn't have a PE ratio of just 5. The PE ratio at least is a starting point, because it does at least try to compare a company's price with something, and in this case, profits. It's not a bad starting point, but I think we can do much better. One of the main things that justifies a high PE ratio is the expectation of future higher profits. One of my personal favourites is to combine the PE ratio with the earnings growth rate to get a PEG ratio, PEG ratio. Put simply, a PE ratio of 10 and an earnings growth rate of 10% year on year gives you a PEG of 1. Anything under 1 is considered cheap, and anything over 1 is considered more expensive. But not all PEG ratios are the same. Who would expect that, for example? Jim Slater, who used PEG ratios as a screening tool, uses forward PE ratios and future estimated growth rates. Future earnings estimates are really in the realms of brokers' forecasts, and therefore having both a forward earnings figure in the PE ratio and also in the earnings growth rate figure is relying, as some would argue, too much on brokers' forecasts. Evidence suggests, however, that in bull markets, lower PEG ratios outperform low PE shares, but in bear markets, they underperform. This is much better than just using the PE ratio, because at least it does qualify the PE ratio in terms of some factor that many investors think is important, and that is future profits and growth of profits that have been experienced by the company in the past. Now, in the early 2000s, a chap called Javier Estrada, I hope I got his name right, wrote a fantastic paper and developed this PEG theory or ratio even further, and he took into account risk. Risk in this context is given by volatility of a share, and he postulated that a similar rated PEG share with a low risk profile outperforms one with a high risk profile, and it seems to be borne out by evidence. He multiplies the PEG by a beta, oh god, this is getting technical now, isn't it, of a beta of a share or risk factor, using more traditional current earnings figures, not estimated future ones like Slater did, to give a new PEGR ratio. It's a PEGR ratio. PEGR? I'll call it a PEGR ratio. And this is the one that I use. Anecdotally, a lower risk stock with the same PEG ratio as a higher risk stock performs better over time. But it's worth reading his paper in full, and I'll put the link in the description below as well. So this is my first stock screening ratio, and it's essentially a valuation criteria. I personally choose shares that have a figure for the PEGR ratio of less than 0.75. Personal choice, you can use 1 or anything you like, but 0.75 seems to be about the right thing. The next sifting criteria for me is return on capital employed. This is really an efficiency ratio, meaning how well a company uses its assets and turns them into profit. Ideally, we want companies to use their assets well. Having too much cash, for example, is good, but can that cash be used for something better to make more profit? You can apply the same principles to any other asset of the company. Ideally, for me, I want a return on capital employed to be above 12%. We can take a closer look at this when we've had our finished sift. The next criteria is unique to Stockopedia, and it is a bit of a cheat really. I fully admit this, as it saves me an awful lot of time. I use their own stock ranks, which is a combination of share momentum, value, growth, and quality criteria. The definitions of these are comprehensively given in their Stockopedia pages, but analysing a composite of lots of different risk factors, price, momentum, cash flows, amongst other things, gives a simple number and summarises these factors. Stock ranks above 80 out of 100 tend to outperform those with lower scores, so I instantly have a very good general feel for a stock that is both performing well against the rest of the market and is valued highly and is a quality stock too. Remember, this is just the initial sift. We won't necessarily automatically buy all the shares that come out of this sift. So these are my 3 main sifting criteria, and this is what we end up with, 19 results out of 2,000. What is nice is that Stockopedia instantly tells you how these 19 shares have performed against the rest of the market over the last year, 6 months, 3 months, and the last month. But remember that past performance is no guarantee of future performance, but at least we haven't got a group of duds here. Now I need to go through these 19 and knock off a few, and this is what I look for now. First off, I want to see sales growing year on year. This is an easy instant graph, but tells me everything I need to know. Next, I also want profits to be ideally growing as well. Next, I also like to see growing cash on the balance sheet. Too much and the company has the option of distributing this as a dividend without borrowing. Similarly related is the net debt figure here. I like to see this falling over time, although that's not always possible. The next thing I also compare is this free cash flow, compared to the earnings per share and to a lesser extent the dividend per share. Ideally, free cash flow should be higher than the earnings per share. I like the company to be paying a dividend ideally too, and also with a dividend cover suggesting that the dividend is not threatened anytime soon. And then I look for anything else that stands out. I personally don't like companies that operate in areas of the world that had dubious political regimes. So I've knocked a few off here and end up with about 10. Well, I own 6 of these already. So I might seriously look at buying these other 4. And that's basically how I do it. It's very simple really, and I'm not getting too sophisticated in my methodology here. I may not be perfect or even very good at this, but it seems to work for me. I'm sure you may have different opinions or may even tell me that I'm doing something completely wrong, but so far, so good. I've been following this strategy for roughly 10 years now and have comfortably beaten the index in 8 years out of 10. And in those 2 years that I didn't quite beat the market, I was very, very close. Incidentally, since the slump in March 2020, my portfolio is now since comfortably above where it was in February of 2020. This isn't trying to be a method of boasting or anything like that. It's just to demonstrate that following these strategies that I've outlined does seem to be paying results in real life. I must stress that investing is never going to be a get-rich-quick scheme, but hopefully a get-rich-over-a-lifetime method, and that just suits me fine. Tell me how you do your sifting. I'll be absolutely fascinated on how you do yours. And if you have suggestions on how I can do mine better, then I'll be very happy to read your comments. I really would. I'm just genuinely interested in how other people do it. I hope you've enjoyed the video anyway. And if you have, then please subscribe, hit that like button and the notification bell. It really helps my channel out. Anyway, I'm Anthony. As always, we're talking money. I'll catch you in the next video. But until then, bye for now.